Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Hello, fellas. Back we are. As any other given year, Christmas came and Christmas went. So we are back from the Christmas, and I personally spent the last 2 days trying to recover and to digest all the excesses from the Christmas dinner and the Christmas lunch with all the food and all the booze. It was quite intense, to be quite honest. But, nonetheless, we made it through, and we are now ready to step back into the new year at this point. We are almost there, another 4 days, and then we will wrap up 2025. Now, as for this current week, I think there is not really a lot to discuss. I mean, it was a shortened trading week. We basically traded only on Monday, Tuesday, and I guess, Wednesday, if you want to count it, although it was half a day. And then we got Christmas. And I really doubt that people were trading the day after Christmas, also because it was a Friday. So who cares? But nonetheless, we are going to check a few things out. Let's try to make it quick, because there's not a lot to discuss, quite honestly. And speaking of which, let's start out from the economic calendar standpoint. The only thing which came out was GDP for the US. So if you look at this measure, it came in at 4.3% for Q3. Although, if you really want to be picky, all right, you might say, okay, but this is just basically the quarter over quarter seasonally adjusted. Saving a lot of, complicated math adjustments. Let's just say they take the quarterly value, they compare it to the previous quarter, the same quarter of the previous year, so to speak, and then they kind of approximate what if this was the rate of growth that we would have throughout the entirety of the year, right? And they come up with an estimate. Now, obviously, this data point tends to be a bit more volatile than usual, and it doesn't necessarily tell you the whole story about what GDP will be at the end of the year for the full on year, right? So in this case, 2025, which is why, although, it came in above expectations because it was forecasted at 3.3, came in at 4.3. So, a full percentage point above expectations. It's or it could seem huge, right? But then again, if you just move to another chart, which should be this one, so the annual growth rate, and this should be real. I think this is adjusted for inflation. Don't quote me on that, but I do think it is. But in any case, you can see that it's a completely different rate. It's still positive. Obviously, we are not into a recession or into a depression yet, or at least nobody said that. And quite frankly, again, the data are not fully supporting it. So, there are risks, obviously, but we are not in a huge contraction. But nonetheless, it's undeniable that, the numbers are particularly different in here. As you can see from Q1, we started at 2%, then 2.1, 2.3. I will leave you to identify the different quirks in the calculations if you are into those kind of things. And, just to highlight a little bit of a difference, right? And, this is what I would deem as a little bit more smoothed out and reliable if you want to try to forecast what the final figure for the entirety of 2025 will be. And again, I've been on the record many different times saying I was expecting around 2%, maybe 2.2, 2.3 if we are lucky. And so far, Q3, it's kind of in line with that. We'll see. It might be a bit higher. It might be a bit lower. Who knows? We'll see how Q4 is going to end up. And, at the end of the day, making predictions 6 months, 9 months, 12 months out, In my view, personally, is always a little bit of a gamble. So, I'm very open to be wrong on this one. Plus, when you basically put your high boundary at 2.3, what if it comes out at 2.6? Is it a huge miss? Well, I guess, kinda, yeah. At the end of the day, 30 basis points above expectations, considering that you were starting out from a base case of 2%, that would lift the miss to 60 basis points. Yeah, that would be, in my view, it would be kind of a miss. But again, it was more of an idea as anything else. So then you progress throughout the year and you try to identify if there are changes, if there are different factors coming into play and all the rest. But nonetheless, for now, 2.3, we are still kind of there. We'll see, right? Now, this is interesting because if you check GDP now, they are forecasting for Q4 3%. So again, it's, don't get fooled. It's not like you can basically pick all the values quarter over quarter for the year 2025 and, adding all them up and then just dividing by 4. It's not a simple average. There are a lot of different adjustments in there. So just don't do that, because you're never going to get the exact figure unless you apply the same rules and the same formulas they do apply, which again, I'm not going to discuss because, again, for the sake of honesty, I didn't fully understand them, right? I'm not a huge math guy, to be quite honest. But nonetheless, this is what we got for now. As for GDP, I guess we will see at the end of the year, so in Q1 2026. And bear in mind, there are probably going to be revisions, adjustments, and all the rest after the fact. So maybe we are going to be 100% sure about what GDP was for 2025. I don't know when, maybe in the midst of Q1 2026, or maybe in Q2, who knows, all right? Now, the other thing which came out this week was the jobless claims, which, again, they're going down quite a bit now, right? Both, the headline figure and the 4-week average, and of course, the continuing jobless claims. Although, they went down sharply and then they just rebounded recently. Although, the last data we got, this one is updated back to, almost 2 weeks ago now. So I'm starting to question again why this one it's not up to date to, for instance, this one right here, right? Which is updated just ahead of Christmas. And instead, the last read we got for the headline was the same, December the 20th. So I guess, again, it's not really up to date, maybe, because, the data was from, was Christmas Eve. Oh, but it was, okay, but they were giving you the data for December 20, as far as I can read in here. So, my bad. it is actually up to date. All right. Maybe it was just, it was just delayed. Or, not delayed, but they were giving you the figure, but for a few days prior to the release. All right. Now, again, we don't have a lot other than that. Let's have a look at the break-evens, which they kept on drifting to the downside. Even if you zoom in, you can appreciate that. What you see is, look at the 5 years compared to the 10. Well, it looks like the 5 years is catching up to the downside with the 10 years. So maybe the market is starting to price in further disinflation, even in the shorter term, because usually what we have observed for the majority of 2025 is the 5 years always being well above the 10-year. So yeah, that could be it. They are converging a little bit. All right. Now, the usual suspects, true inflation as for PCE, 2.12. It came down a bit more compared to the last time we talked, which was last week. So yeah, it came down a bit more. And what for the headline CPI, 2.30. So Yeah, it was a bit higher than that last time I checked. Yeah. So, okay, but we are not, again, as if there was any need to restating that, but we are not seeing any signs of runaway inflation for now. Fed Watch tool, they're pricing in no cuts, but again, next meeting will be January the 28th, so month out. So the break-evens are not really showing you something of particular relevance, if not the fact that everything seems to be calm for now. They are at the lows. And same goes for the VIX, so volatility, which again, all else being equal, should lead you to believe that markets are not in an immediate danger. Now, although with volatility, by design, it contracts and it expands. So every single time it gets particularly low, it is, prone to a sudden spike just because, it doesn't really apply every single time, but I think in this case, it would be a perfect fit. All right. The usual sentence, can't go lower, bro. Right. Yeah, actually can't go below zero at a point. So, but we will see. I guess, the week we just ended, it was a very dull week. Not a lot of volumes, not a lot of nothing. People were just celebrating, or at least, not to make discriminations, but people which are moving the most amount of volumes in this market, right? So I doubt there was anything substantial to conclude out of this week. If not, we have seen a few things, something which went as we were expecting, something which was particularly neutral, but we are gonna dive into the charts right now and have a look at that. So this is probably going to be relatively quick with the charts. I just have, some sort of a topic that I want to dive in a bit deeper. But other than that, the charts are always the same. For instance, let's have a look at the major currencies. And what you see is that, the DXY, after the bounce coming off of the previous area of support, because it was the origin of this impulse to the upside, the bounce was faded quite sharply, and we are back to the same short-term lows that we put in, and we were looking at them just the other week. So the euro, conversely, just tapped back into the same level which provided the rejection last week, and nothing else changed. If not, again, it looks like the trend is up for the euro and it's down for the DXY. Same for the British pound. I think at this point, the British pound, we reclaim these high, we reclaim this one. So maybe we are probably going to test back into this previous apex. Although, would you call it a front run? Well, I think we're going to tap it. It's easy to say at this point, we are basically there, but yeah. So let's put it this way. If you're expecting some sort of a major pullback, probably the best area to start to look for it would be around this apex right here. Am I saying complete reversal and it's gonna keep on plunging back below the lows? No, but just a more than decent pullback, I would say. Not to say it's gonna come, but if you are looking for it, this is basically the area or the region where I would look for, right? The Japanese yen, it tried to came back up. It looks like it, we completely filled in the inefficient leg to the downside now, but we stopped right there, and it looks like it's again rolling over once again. It's just 1 day of trading in here, which is not enough in my view, but it's not the picture of health. So I wouldn't expect immediate strength. And we have been discussing all the fears about the carry trade unwinding and all the rest. Yeah, sure. For now, not really evident or not reflected in the price action, at least relative to the yen. Again, same old topic. The interest rates differential in between JGBs and US Treasuries, that could change, obviously. But in order to see some sort of a real unwind, I would need to see these one right here, that the currency actually spiking to the upside, because it's not really about the direction. Sure, the direction plays a role. If it doesn't go to the upside, you're not going to see an unwind. But I think if it goes slowly and gradually, people have time to adjust, right? To put in place hedges to those positions they have on leverage and all the rest. The problem is always the rate of change, right? Which could basically catch many people off guard, right? But if it's not moving real fast, I don't see an immediate danger. Although, again, we've seen it in the past, just to give the other side of the coin, that though, when those things happen, they do happen real fast, right? So always be mindful of it. And I mean, if you're involved in this sort of a trade, it's not a bad time to take precautions, especially if you want to hedge yourself with I don't know, with volatility this low. You could use options. They should be cheap enough, given that at this point the implied volatility should be lower. So I guess you could buy insurance with for a chip at this current moment in time, right? The Canadian dollar kept on going higher, as we can see. And we are basically back around the highs that we put in when? September. All right. So full circle, right? Huge pullback. And now we came back up. Let's zoom out a bit. What do we see after this level right here? All right. Assuming we have enough juice to get back into it. What do we got? Guess not a lot. Could really come back up to, assuming we break it, right? Let's say the trend is a trend and it stays intact and we keep on going, could come back up to, 134, 135. And again, in this case, the chart would go back down because you're looking at it inverted, right? But just to clear out the air. Now, the Swiss franc, it's still the same. We are now trading around the high side of the range, but up until the point we don't break it one way or the other, I would run off of the same assumption that it's still in a range. It's kind of the same with the trend, right? The trend is a trend. Yeah, same. The range is the range up until the range is broken, all right? Now, the other currencies, again, not a lot. Like the ruble, it's basically getting back to the levels it was back in July, and then again August, October. So it looks like we established this sort of a range with the highs in here, the lows in here, and this is looking like the midpoint, or you might say the fair value for now. And every time we try to run away from it, we always mean revert toward it. So yeah, I guess if you trade it at the edges, you might have an edge. No pun intended. What else? Chinese yuan going up, South African rand going up. Sometimes, you could stop and look at the implications of the Chinese yuan going up. Since we basically just talked about GDP, one of the major contribution to GDP being above expectations was that, when you look at the balance of trades, there was a tiny boost in exports and a slight decrease in imports. Now, bear in mind that if the Chinese yuan appreciates against the US dollar, that makes, importing by Chinese companies overseas a little bit less attractive. Now, again, we are talking cents on here, right? So it's not really what could majorly impact those dynamics, but nonetheless, it's just the reason why countries and governments tend to try to manipulate their own currencies at the end of the day, right? Now, what else? The Indian rupee. Was it faded once again? We might have a last chance to defend this bounce and to carry it on, but it doesn't look healthy. No, maybe. If we can hold in here, reaccumulate and try again higher, but considering how the trend progressed, still bearish, I guess, up until we are told otherwise. And the Brazilian real kept on plunging again, so nothing really changed. The Australian dollar kept on doing the same. So we were talking about the asset getting a bit overextended. It pulled back for basically what? I guess 2 weeks, more or less. And, tiny consolidation, and then we broke out of these current short-term highs. And we took out this level right here, this level right here. So, I mean, if things keep on going, we might see probably 68 cents in time. Probably not tomorrow, but, in time, right? So that would be it for currencies. Let's have a look instead of what do we have next. And next we got, of course, oil. Oil, I mean, if you look at it like that, it looks like it was extremely volatile. And, on an intra-week base, it was. But, when you zoom out, you go on a weekly time frame, what you see is that, well, basically, we just closed this week slightly above where we closed down the week prior to it. So, all in all, week over week, not a huge change. Although, intra-week, this rally was good. Like, we basically pumped for 2 days straight. We got back to the same, what was that? The same channel or channel boundary, right? The upper part of the channel. We traded above it for like 1 day, and then we were rejected back to, well, the mean. If you imagine a line in the middle of the channel, that would be it. If you are just looking at the structure instead, you could say that we basically got back to base at this point right here, right? Now, so the next part would be, what do we do now? I mean, can we actually hold this base in here and try and again higher? Let's make it black, right? Or do we crack it and we get back to the same old trend, which was obviously down? So I guess, the first point of contention will be this one, and the first decision-making level will be here, getting into next week. I don't have a particular preference. If not, again, going with the trend, so probably down. Although, it's year-end. I guess, there is a lot of window dressing in this period of the year. So same for this week. Even next week, I wouldn't really trust a lot of what we see, right? I mean, sure, it's going to offer up tradable opportunities, but, it's hard to grasp what could be the next 2 weeks, 3 weeks of price action simply from what we are going to see these days. Lighter volumes, not a lot of people involved. So I would wait for the new year. I guess, after the first week of the new year, we are about to see new positions being established, and we will see where people put their money, right? Now, let's have a look at Bitcoin, which again was another one of those not particularly interesting because, well, nothing happened, right? I mean, last week we closed where? We were discussing it on a Saturday, and it was basically in here, right? And it was what, 88 and some change. And we are now 87,600. So the only thing we saw was a little bit of a rally attempt in here, which was faded the same day. And then again, it went down a little bit. It tried again just yesterday, and it was rejected. So, I mean, there's really not a lot to look for here. Like, unless you want to identify this one right now as the current or the nearest level of resistance. And so, again, up until the point we are living below it, you should be bearish. But again, by the same token, this was a level of support and we are still living above it. So I mean, we are just stuck in this tiny consolidation right here. You know, directionally, up until the point we don't break out one way or the other, I guess there's not a lot to discuss. But again, at the end of the day, that was basically the assumption at the beginning of the month, if you just remember the first video of December. And we have been staying on that premise ever since. So, yeah, nothing really changed. Now, is there anything else to say about Bitcoin? I don't think there is. Like, I mean, unless you want to discuss MicroStrategy, which I don't. Oh, we touched a little bit on it in the past, and I think the situation never really changed. So, you know, I would leave it at that up until the point something really changes. All right. So let's have a look instead. I know I sound like a broken record, but something else which didn't really move a lot, yields, which you know, they just came back down, right? So tiny little bit of a spike on what was that, Tuesday, and then, you know, they just came back down. So nothing conclusive in this one, if not, again, the steepening process, because you see the short end going down faster than the medium and long end. And other than that, you know, there is not a lot. So yeah, I would completely skip these ones and move on to the next topic, which would be gold. Yeah, so let's have a look at gold. Now, this one moved, all right? Now, we got new all-time highs for gold right now. Last week, we were discussing how nice it is for long-term investors to see their favorite asset going up slowly but surely, grinding to the upside, being very efficient. Well, I guess it's always the same. You say something, the market listens to it, and it decides to do the exact opposite thing, right? So we had a massive surge, we had a surge on a Monday, straight out the weekly open. And, you know, we never really pulled back throughout the whole week. So what is now? We closed at 4,562. The peak was at 585, more or less. So, yeah, I guess, again, we're still in a bull market for gold. It just, you know, we just took a brief pause in the grand scheme of things, where, you know, this pullback right in here at the end of October, and then, you know, slow reaccumulation, right? I think, you know, the trend is the trend, so can't be bearish on gold. And I don't know what type of targets people would have. I mean, for the yearly targets at this point, I think, you know, would you say we tap into 4,600 or 700 before year end? We got basically 2 days and a half of trading left. I don't think so, but by the same token, I'm not expecting a massive pullback right at year end. So I guess this is a pretty good result for gold getting into year end. And I think, you know, it probably won't change that much. And if it does, I think, you know, on the euphoria of end of the year buying spree, if anything, maybe a bit higher than these, but, you know, I don't think there will be a major change in this one. Considering, again, we are going to have war. 2 days, 3 days. Now, if you want to include the entire week, we will discuss on January the 3rd about this one, and let's see what it did for the entirety of the week. But if you want to draw the line at year end, I think this is pretty much it. I wouldn't expect something huge out of it in just 2 days, right? Which, you know, this is a good point to stop for a minute and thinking about something. Now, everyone knows at this point pretty much that precious metals are basically on the front pages of every single newspaper, right? And gold is just the tip of the iceberg, because we have seen, you know, platinum. Have you checked platinum, right? Other metals, even industrial metals like copper, are having a particular good run. although, copper a bit more volatile. But, the other, let's call him the gold baby brother, which would be silver. Silver had a huge run, especially recently. And, it just, I guess it just hit the news at this point. So let's have a look at silver instead. Look at that, right? And now, mind you, this is a daily candle for silver, which basically went up from 71 up to 79 in just one trading day, which was yesterday. And if you measure it, it's 10% in a day. So I guess, we are in a silver mania at this point. There's nothing new under the sun. You're going to see these things from time to time. You see it with, again, as I said, copper, silver, gold, palladium, and many other different assets. I mean, is it that different from one of the charts? If you go back in time and if you look at different price segments, this could be the chart of one of the Mag 7 or one of the semiconductor stocks that we've seen doing crazy things for, all 2025. Now, why silver is it interesting? I mean, it's not particularly interesting to my point of view. It's just, the talk of the hour, right? But it offered up the opportunity to have a nice and relaxed conversation about how do these type of runs eventually end, right? Now, again, it doesn't mean that I'm expecting silver to crashing tomorrow, right? Actually, I think, same as gold, I think it's probably going to keep on going for a bit more, right? Do I have a price target in mind? That's not really my goal, especially when you're looking at a clear sky breakout and price discovery. I tend to just wait for the market to put in a low or a top. I'm not good at calling tops and bottoms. I'm not even interested because, again, I stated many, many times, I think there are many ways to make money in the market. Calling tops and bottoms, I don't think that's the best way over a long enough period of time to try to go and make money. So I don't have a price target for silver. You could use the usual, round numbers or psychological levels. So in this case, from 79 to basically almost 80, it could be the right point for a pullback, or we short directly to 95 or 100, So that's the thing about rounded numbers. They are either front run or overshoot most of the times, not always, but most of the times. So I wouldn't put a precise target on it. But I would say one thing, right? Now, of course, everyone is talking about silver, and it's again the same as we discussed for gold. Everyone is saying that, the world is coming up to acknowledging the fact that the system is failed. And from here on out, if you don't have hard asset, you're going to be screwed. Yeah, all the rest. Do you remember when I said just last week, go figure, if your local dealer is trying at any cost to sell you out the silver or the gold, because that's the only way to save yourself from financial Armageddon, always wonder, if that is true, why are you willing to sell it out to me instead of keeping it to yourself and save yourself from the financial Armageddon, right? But beside that joke, there are something which it might be particularly serious to discuss. Now, again, probably silver is going to keep on going for a bit longer than this, all right? Maybe. It's totally possible. Although, I would say that what you see in these stages of euphoria and massive, mania is that people not only buy the underlying, or, they buy spot, or they buy the ETF, or they buy the physical silver, right? Which is, totally legit, right? I don't have silver. I got gold, both physical and not physical, but there is a nice phenomenon you see, and it's kind of like the same we were discussing, I guess, 2 weeks ago, when, in that case, it was about the stock market. And I'm referring to margin debt. So people take on margin debt, or in a nutshell, they use leverage. Now, when you see an increase in leverage, or when a good chunk of the price variation you are currently witnessing is driven by leverage, you do know that at a point, the same as it came, it will go away, right? So always bear in mind that, you never know when it's going to come, but, if history is any good teacher, it is going to come. So I took the liberty of putting together a little bit of a summary of a few quotes, a few articles, a few studies on silver and what happened in the past. So let's put it on the screen and just try to briefly go through it together, right? I'm not going to read it all, but you're going to be able to if you wish to. I'm just going to look at the highlights, so to speak. So, silver, of course, it went parabolic. It's almost 3 times the price it was in 2023. And of course, that's a chart. It's a 3-month chart, so a quarterly chart that I added just, to highlight what happened. Now, the focus of these tiny conversation, it's not strictly about the surge or the surges of the past, but it's about how they ended up. And, trying to understand why these type of surges in time always ends up kind of the same way. Because one of the sentences you're going to hear a lot, I guess, because I just heard it just a few days back, both for, it was massively related to gold, but it applies on silver too. It's the usual cliche, right? We are never going to see these prices again. Maybe. Or maybe not, right? And when people goes like these, I'm always a bit skeptical because, not only it's euphoria, but how can you tell, right? I know there are a few prices that maybe you're not going to see again in a time span which is conducive to what you are doing for yourself or for your available investing life. But saying that we are never going to see one specific price level again, I think there is a huge degree of, too much confidence in that. And just look at the chart and you will see that we, even in the past, I guess maybe when people were looking at these or at these, they were convinced they probably never going to see those same prices again, before the surge. It's just that, after that, they saw them once again for quite a bit of time, as you can see in here. And, to a lesser degree, but even after this spike, after the financial crisis, silver actually got back to it and below it. And, it took almost 6 years to reaccumulate and keep on going higher eventually, right? So not to say that it doesn't happen, that it's going to go up and up and up in time. Just make sure you're taking notes about these long periods where it just does fuck all. Because those would be dead money if your goal is to build up wealth and increasing your portfolio over time, right? Now, let's have a look at those two moments, those two previous surges, right? So after the financial crisis, of course, what we've seen is that there was a huge response from, the government and the monetary authorities and all the rest. And of course, silver rallied 500%, right? And it went from $8.5 up to 50 in just 2 years, right? So basically, it was most of that was put on the overreaction from the Fed, right? Because they're talking about monetary response, right? And as you can see, they slashed rates to zero. They introduced QE, and they basically bailed out the system. So interest rates, even when adjusted for inflation, we are talking about real interest rates, they collapse into negative territory. And of course, what you see in the graph below is, we can get to it, in orange is the real 2-year US Treasury yield, which, as you can see, it went negative after adjusting it for inflation. The nominal yield, obviously, it never went negative, right? But I mean, we were around zero, right? So, that would be it. And look at, in green, this would be CPI, so inflation. We actually had deflation. The green line went into negative territory, right? So just to give you a context of one of the reasons why the market perceived what the Fed was doing as massively inflationary, and therefore silver and gold too. I mean, those hard assets actually catched a bit. Now, if you keep on going, again, the monetary environment was conducive, obviously, right? But also, there was the advent of all these different instruments by which you would have been allowed to actually buy yourself exposure to silver. But at the same time, they brought in speculative investors, people using futures, options, and all other form of leverage, right? In order to artificially and significantly increase demand. It's like what always happens, right? It's the same talk I was making for gold. Yeah, maybe gold is going up because central banks are buying, but don't discard the fact that a lot of people are piling in just because they see price going up and they know they can make a profit off of it, right? Now, sure, the boom ended in 2011 when the CME raised the margin requirements 5 separate times in 9 days, right? As you can see from the graph below, right? They basically forced a deleveraging in the futures market. Now, I guess here we start to get into debate, but is silver or gold or any other precious metal, is it really driven when it comes down to price by underlying fundamentals and therefore what's going to happen to the physical metal, or is it just a matter of derivative contracts and all the rest? I do think if you look at the long-term trends, when we talk about years and decades, obviously what's going to happen to the underlying, so to the actual commodities, it's what is driving price. The problem is that you have, throughout that period, you have many other short-term periods where I do think this dynamic in here plays a much bigger role. And again, getting back to leverage and the proliferation of all different instruments which would grant you exposure to these assets, right? And what happens when they take that leverage and they take it away from you? Well, you have a deleveraging event and the price of silver actually falls back quite impulsively and quite sharply. So the problem with it is that it is all well and good. Like if you think about holding physical silver for, maybe your entire lifetime and you want to give it to your children after you pass, that's all well and good. I mean, you're not going to care about the volatility that you're going to see from 1 month to the next or 1 year to the next, or maybe even 1 decade to the next, right? But the problem arises when I hear people saying, yeah, first, I was holding it, but now, since it's going particularly well, I started to add leverage to it. Again, it goes fine up until the point it goes fine, but just as a friendly reminder, just make sure to know where your leverage is and where your stops are, and especially knows when to take profits, because you wouldn't be the first one turning a massive home run into a spoiled trade. And people actually went bust by keep on adding leverage when everything seems fine and nothing would have been able to stop this trend up until the point something actually stopped that trend, right? And everything reversed. And if you have leverage position on, just again, leverage, and especially deleverage, it's something which can happen particularly quickly. And again, it happens, not always willingly, which means that it's the broker to liquidate your position for you if you don't have enough margin to maintain the position open, right? So that's one of the things with leverage, all right? After that, what we've seen, if we run off by history, basically, it's the 70s. Now we are getting back a bit more to, in the timeline. If you don't know, I guess it's pretty famous, but there was a period throughout the 90s. It was at the end of the 70s. It started out in the beginning of the 70s. It dragged out for the vast majority of the decade, and then it exploded spectacularly at the end of the decade. Now, the Hunt brothers, right? they already had a lot of stuff, as you can see, and then they saw what was going on with, many different commodities. They witnessed the formation of the oil cartel, aka the OPEC, and so, they came up with this idea of kind of hedging their own business. But, since they couldn't do it with gold, because back in the days, nobody was allowed to actually own gold, they picked silver. All right. So, up until this point, everything makes sense. There's nothing wrong with it. So they started to buy silver. And of course, over the next 6 years, as you can read, they kept on increasing their holdings and all the rest. So yada, yada, yada. The story for now, it's going completely in their favor. They look like geniuses. And then what happens is that, in 1979, they have a huge holdings of silver, and they, can actually impact the market. The thing is that the CFTC and the CME, all right, they did what? They did the same, right? They sought to restrict the purchases and compel the liquidation of broader silver's asset. And therefore, in 1980, CME enacted Silver Rule number 7, which again just imposed restrictions on the purchases of silver futures on margin. Again, you see how this thing it's keep on coming back, right? And by the same token, it increased the level of collateral which was required to traders to put on up front in order to be able to open the position, right? And of course, they also limited the number of contracts that you could have, bought. And at the end of the day, they effectively halted the new margin buying, right? So these changes, of course, had an impact on what the Hunt brothers were doing, right? And at the end of the day, they couldn't add leverage anymore. So silver hit $50 per ounce in the middle of January in 1988. And then, since, the leverage was taken away, it fell back down to 10. Now, again, just quick mental math, but going from 50 back to 10, that's more than your usual 10, 15, 20% drawback, right? That's a crash, essentially. So just, when you think that you're never going to see some specific price level again, maybe it could be anything is possible, but maybe just think twice, right? That was basically the price surge that we had throughout that period, if you can read years, right? And that's how it ended up. Again, we're talking, this is a monthly chart, right? So it didn't really happen all at once, right? But, if you just look at this candle right here, imagine being long on leverage, balls deep, the day when the floor breaks. I mean, that's a career-ending move. Or if you basically bet the farm on it, that could be really financial Armageddon, provided by the same thing that should have prevented you from suffering the financial Armageddon. So, it's always the same. The leverage gives it, the leverage takes it away, right? So just, does it have to end like this every single time? No, it doesn't. But, it's always useful to assess the risks, especially when you see that these things, they can actually happen, right? Now, this is a brief summary of, how the Hunt brothers actually played this game up until the point they were able to play it. So they initially just had the holdings of silver, and then they started to buy it on a margin, and basically what we've said. And of course, they ended up going bankrupt, right? So for quite a while, they cornered the silver market up until the point the market was always right. And in this case, with a huge help by the CME and the CFTC and all the rest, leverage just evaporated and price reverted back. And again, this is why one of my favorite quotes from financial markets literature is that the most impactful force in this game, it's mean reversion, right? So, what about today? Now, today, if you look at the fundamentals, right, it looks like these run up on silver, same as gold, same as maybe platinum and all the rest. It is actually legit, right? There are fundamentals reasons for silver to be up that much and to keep on going higher. And it might keep on going for another, I don't know, it could be another 6 months, it could be another year, right? Who knows? You never know, right? But the point is that you need to manage the risk nonetheless, right? So these are the potential drivers from a fundamental standpoint for silver to keep on going higher. And again, since it is a commodity, a lot of them will actually resonate, especially, if you're thinking about all the parallels you could drive, between silver and maybe any other industrial metal or a commodity like oil, right? Since we always discuss oil every single week, especially when it comes down to the underinvestment, to the industrial demand, the demand due to economic growth and all the rest, right? Now, as for now, people, in order to value silver and silver price relative to other things, they're using these ratios right here. So you got the silver to crude ratio and the silver to gold ratio. Now, although it is true, if you look at the one in green, which is the silver to crude, is it? Yeah. It's, particularly high. I guess it's never been that high, right? And, I guess that, in order to have this spike to be resolved, either you will see oil prices really going higher, right? Or silver would be due for a major correction, right? So it's one of the two, right? We'll see. I'm not particularly bullish on oil, but again, we're discussing macro, so maybe this spike will be resolved in another 6, 9, 12 months. And at that point, even the landscape for the oil market will be changed, and even for the entire economy, maybe, who knows? The other chart in blue, dark blue, as you can see, that's the silver to gold ratio, which is spiking at the current moment in time. It's not one of the biggest spike in history, but if you assume it's going to keep on going, that would mean that silver should keep on overperform against gold. Although, as they do point out, historically, what you see is that the trend of this ratio right here is to the downside. So maybe, just hold your horses a little bit. Don't necessarily expect that it's going to come back up to the highs we have seen in 2010, more or less, or 2011, right? Just, to tame or to curb your expectations a little bit, right? Because the trend is down, which means that historically, at the end of the day, yeah, you see price surges here and there, and periods where silver actually overperforms, but overall, it looks like historically gold did much better over time. That's always the key, over time, right? Otherwise, the ratio, it wouldn't be shaped up like this, right? Now, so you might say, okay, but we're not seeing anything which could lead us to believe that silver has any reason to come down. The sentiment is good. The narrative about money debasement, the fiat money going fucked, all the rest, that's pretty much in place. The Fed actually started back QE. So again, more monetary printing. Although again, you do know how it is, right? It's not money printing. And again, to all of those which say it is, I'm sorry, you didn't do your homework. I'm sorry. Now, there are other implications you can derive from that not money printing, aka reserve printing. But, if you want to understand something, I would say that, first of all, you got to be straight on the definitions, right? And then you can extrapolate the potential mechanical consequences. But yeah. So what about now? Is CME about to spoil the party again? As we've seen in the past, right? Now, the problem with that is that just recently, on December the 12th, the CME raised silver margins by 10%, right? So they are already trying to take away a little bit of that leverage. And if you remember anything from a few minutes ago, it looks like that's particularly important for this rally to keep on being sustained, right? Now, 10%, of course, is not a huge, a big of a deal at the current moment in time, right? But, let's just hope they don't go farther, right? And this is what they sent out to people just to, to warn them that these changes would have been made. And as you can see, you got the current initial and the current maintenance and what is going to be the new initial margin required and the new required margin in order to maintain open positions, right? So it's going up. 10% is not a lot, but as we've seen here, nobody tells you that in another month, maybe, or 6 weeks, or whatever they're not going to come back again saying, well, it was a 10% increment back then. Now we are going for another 10% increment. And in time, it's going to add up. So you don't know, which is why, again, I want to stress the fact that we are talking leverage positions, right? And I'm going to repeat it again. If you are holding physical silver for the next decade, I guess you shouldn't even be bothered by all of these, because at that point, you don't give a shit about the intra-week, intra-month, intra-year volatility. It's just like you're taking silver, you're putting under the ground and saying, you know what, I'm going to dig it out in another 10 years and I'm going to see what's going on, right? So that's the mentality of long-term holders, I guess, right? So in that case, all of these, it might not apply to you, but if you're playing with leverage in the futures market, or if you're starting to think, or if you already thought and actually done it, if your intention is to add leverage on top of your physical holdings, just, I'm not saying you're going to be fucked, but just say, maybe I should consider this one. Just for the sake of it, since it looks like in the past, bad things tend to happen when everyone goes for a new euphoric spree like that, right? So again, silver investors should carefully read the section, especially the one detailing the post-financial crisis period and the Hunt Brothers boom and bust cycle, because changes in margin requirements could trigger massive liquidations. And again, settling that debate, at that point, does it even matter if what, over the long enough period of time is driving the price of silver or gold or whatever, it's the underlying asset and the fundamentals, or if it is just the current speculative euphoria? Does it matter if the asset you're in, and you're in with leverage, if that drops 30, 35, 40% in a very quick manner or in a very short period of time, you're fucked. I mean, you might be right in the long run, right? It drops 50%, but, next year it's going to be up 150%. It's kind of like Bitcoin. Yeah, it got those 80% retracements, but if you look at the chart, it just goes up over time. Sure, unless you're using leverage and that pullback completely washes you out and you're fucked. This is why you need to pay attention to it, right? So at the end of the day, right, all of these is just trying to provide a lesson on high price that leverage can inflict on investors, right? That's the whole point, right? The other bigger and crucial point is that timing these things is actually complicated, because you never know when those in charge of allowing you that degree of leverage, or that other degree of leverage, will come in and saying, well, you know what? No more leverage for you. I'm sorry. Or, well, you know what? We are about to double up the collateral you need to put on up front in order to even being able to open up a position, let alone those that you already have and you need to maintain, right? So the last sentence is particularly evocative in my view, right? Fool me once, shame on you. Fool me twice, shame on me. But fool me 3 times, right? So, yeah, I just found it particularly interesting. And again, doesn't mean that the price of silver is going to collapse tomorrow morning, next week, next month. It is just that the more it keeps on going like this, the farther it goes, the weaker it gets. the more margin you add, the more the mean reversion will be severe when it comes. And, you just need a catalyst. Sometimes it might be a fundamental catalyst, right? Or, sometimes it would be just a market dynamic like margin requirements. The bottom line is pay attention, try to be nimble, and don't take anything for granted. Right? That would be the entire point of it, right? Now, after that tangent on silver, because we didn't really have anything else to discuss this week, let's have a look at the stock market and end up the video, right? I guess this is another one which is going to be quick because, the stock market didn't really, do a lot. It kept on going higher. If you look at the heat map, straight out the gates, if you see NVIDIA, Google, AVGO, AMD, if you see these names, being in the green, quite substantially, especially if you think about these two on the left, you could already expect that most likely the indices perform particularly good, considering the weight these sectors have on the entire, market. At the end of the day, even Oracle actually rebounded, although I wouldn't bet the chart looks any, substantially any better than what it was like last week, right? But, at least it's a start. It's just a tiny bounce, right? But let's have a look at the charts instead. So this is what you see. So last week, if you remember, we ended up saying, well, at the end of the day, the week wasn't so positive, but the close was good enough. And especially relative to the S&P and the NASDAQ, they managed to come back up above the weekly open. The NASDAQ was a bit better, right? Because it came back up, it tested back into it, and it bounced, closing down the week. And, ES futures, they tapped into it. They were rejected initially, and then they closed the week above that. So that's nice. So we started out with a gap up, so new week open gap up. We kept on rallying for, Monday, although, as it's often the case, or, at least as it's often has been the case, right? In December, at the very least, as soon as the market opened up for the New York session, we immediately saw a drop. And again, that was, particularly consistent throughout the last 20 trading days, more or less. Maybe a bit less, but more or less. Let's say the month of December, right? So there was an edge in that alone. Either you were trying to short the opening range, or you were giving it maybe, 30, 40 minutes, right? The first hour maybe, right? And then try to long at, after the bottom was put in, because at the end of the day, we almost never had some sort of a sustained down move for the rest of the week, right? So, yeah. Now, what you see is that on a Tuesday, again, another push down. And, this time around, instead, immediately at the American markets open, you see the market starting to rally. So this time around, that's good, right? We keep on going higher and higher. On Wednesday, I don't know how much weight would you put on it, because, again, it was Christmas Eve. But, the day was particularly contracted, but we ended up basically around the highs, right? And finally, we got yesterday trading, right? Where, the market, it really didn't go anywhere. We tested the upside, we tested the downside. And at the end of the day, we closed kind of where we opened up, or in the middle of the range. So nothing really changed. Now, if you zoom out, what you see is these, again, another reminder, not back adjusted charts, right? But ES futures just printed new all-time highs on a closing base. So, I guess the up move, which started on December the 18th, right in time with the usual Santa Claus rally and all the rest, it actually unfolded itself. Now, again, the others, like the Dow, it's moving in the same direction, new highs. the Russell is staying relatively tamed for now, and of course the Nasdaq, it's the one which is lagging for the time being. So we'll see. But overall, you can't deny that we had this up move. The timing for the Santa rally is not over. Like the window for the Santa rally is not over yet, because it's about the last 5 trading days of the year. So that would include Christmas Eve, Friday, and then we are gonna get Monday and Tuesday. On Wednesday, I'm not sure. I would assume it's gonna be probably half a day, but again, don't quote me on that. And for the first 2 days, 3 days of the new year, I should check. Bad me, but I was distracted by the holidays as anyone else. I don't know if the market will be open on the first day of the year. Probably not, I would say. So we are gonna get next Friday and next Monday to basically close down this cycle of the Santa rally, right? Which again, for now is going well. And the stats were basically telling you that it's been negative for 2 years in a row in the past. And we're talking about the performances throughout the Santa rally period or window. So it was difficult. It doesn't happen that much that you have more than 2 consecutive negative performance returns. I'm getting stuck. I'm feeling it, but you get the gist of it, right? You can be disappointed just a maximum of 2 times in a row with the Santa rally. So now that's settled the scores, right? So having a 3rd time, that's very unusual and never happened. And it looks like so far it's not really happening, right? So unless something drastically change in the next 3-4 trading days at this point, considering again weekends, festivities, and all the rest, it looks like we are on track, right? Now, here, if you want to see historical returns, right, for that period of the year, here they give you when it was positive, when it was negative, and the percentage change in price for both of those scenarios, right? So that would be it. At the end of the day, even if we check the ETFs, you remember the only one thing we were looking for is, can we find the bottom in here, and can we have the stochastic, so the momentum actually turning back up? Looks like we did. Now, I guess at this point, you would like to see it keep on going back toward the highs, which ideally should bring price a bit higher than where it is right now. But again, bear in mind, as I just showed you, the historical price changes. So on the top of my head, I would say the average it's 1.4%. So, let's just take, for instance, the S&P or the Spiders ETFs right here. So you would say that from the 24th of December, where would you see price at the end of the period? So last 5 trading days of the year and first 2 trading days of the new year for a maximum of 1.4%. Well, should definitely make new highs. Now, again, also remember that although we all look at 4 different charts, so the major indices for the US market, the stats are just good for the S&P alone. So again, don't be misled in the fact of, thinking that, well, yeah, I mean, ES futures went up, but look, the Nasdaq is lagging. Yeah, sure. Because the data are just presented for ES, for S&P, right? I guess you wouldn't have any difficulties retrieving the data for the other assets. I guess with artificial intelligence these days, I guess you could do that. I'm mostly interested in the S&P because I'm just looking at the broad market, which again, once you say it out loud, and then you do realize that 37% of the S&P, it's just reflected by 7 stocks. it's not really like you're looking at the whole market. But again, we actually do operate with what we do. Do I check the equal weighted index from time to time? Yeah. Absolutely, you should. And we have been discussing breadth and all the rest many different times at length over the past few weeks and months. So, at the end of the day, what would I say getting into the new year? I don't know. Again, we have been discussing all the different type of risks, which again, isn't it strange, right? I just recorded a section on gold, silver, and mainly why silver could end up badly. And every single time, now that I'm thinking of it, and it might be because we are really getting into year end, so you start to think about what you did. But just allow me a brief moment, because it ties in with the conversation about silver. What do I do? How many times? I guess you can count it. How many times over the last quarter? Let's just take the last quarter, right? Don't stretch it out too much if you don't want to stretch your memory back in time too much. But how many times I told you that I was overall bullish the market by looking at the charts? But when we do actually discuss technical analysis, right? And every single time when we were looking at all the different slides, what we're looking at, things which in and of themselves, they weren't particularly bullish. Actually, we were always trying to assess the risk. So again, it's kind of the same mechanic. You can be bullish something, the chart can be bullish, the chart can keep on telling you that you should be bullish, right? But I guess the pursuit and the research and keep on seeking whatever could throw a dent in your thesis and whatever could invalidate that, it's priceless. Like, if you keep on doing your homeworks, at the end of the day, over a long enough period of time, the market will reward you, because as an individual trader or investor with no ability in any way, shape or form to move price around or to manipulate price or to have access to privileged information, the only thing you could do is manage your risk. So the famous quote or cliche, which is good now as it was good for the majority of financial markets history, if you can take care of the downside, the upside will take care of itself. So this is what, on a niche, we should try to do, right, for our own selves. Let's just try to see if you are positioned well, right? If the market is rewarding your view and your thesis, right? So check. Right now, you should keep on staying in that up until the point something changes or something new comes up and invalidates your thesis. And, if you haven't read the market wizards, there are a few rules about investing, like the trend is your friend, be careful with your sizing. Sizing can hit you more than being wrong on direction more often than not, right? But about keep on riding the trend, there is that quote about the thesis being right, and the thesis keep on being right. So up until the point, you stay in an asset up until the point that same thing, the reasons which brought you to be in it are actually evaporating. And at that point, the game is not worth the risk anymore. If you don't have that underlying thesis or premise that brought you in the first place. And every single time we were trying to analyze what the macro environment was and saying, yeah, you know what? Maybe it's not that drastic now. It's not that evident now. But this is something which in time, if it gets worse, if it keeps on deteriorating, it could impact the market. So just in case, we are going to keep on monitoring. And if we see that the situation is changing because of this and that, we will try to adjust. And, I guess, everyone tried to do it. And by looking at this survey, what can we see is that, among the following things, what do you think would pose the biggest risk to the market in 2026? Now, it's a little bit blurred, so it's hard to read, but the majority of people actually answered tech valuations. All right. And then new Fed chair pushing for aggressive cuts. which, yeah, I mean, because of what? Because of inflation coming back up, and therefore then they have to actually raise rates. But maybe, actually, I mean, if you think about the situation, everyone is keep on referencing 2008. I think when this AI bubble, if and when will pop, this is going to look like a bit more like the 2000s with the dot-com bust, not necessarily 2008. And then what do they say? Crisis in private capital. Yeah, I mean, we have seen strange things happening in the repo market, and I guess even throughout this week we've seen something going on in repo, but I didn't have the time to check it deeply enough in order to present it. But anyway, bond yields rise more than expected. Well, they would assume economic growth more than expected. So I don't know. Again, don't truly believe that. For now, we'll see. Central banks hike, yeah, which would be tied in with what? With a new Fed chair actually sparking inflation by cutting rates, and then they would have what? Yeah, central banks hiking because unexpected inflation renaissance. Okay, AI impact on unemployment. Well, that could be one. All right. Although, I think you're going to have more than plenty of time to see it unfolding itself and adjusting for it. What's that? Well, yeah, okay. Debt sustainability. Bank of Japan. So we get back to the carry trade blowout. Turmoil in crypto assets. Really? But why? I mean, the markets kept on doing what the markets were doing for decades before cryptos even came into place. So I don't see why turmoil in crypto assets should, in time, impact the entirety of the traditional markets. I mean, I don't think they reached into that level of capitalization which could impact, or they were spread out enough and represent a big enough chunk of good guys' portfolio now that, I mean, even if they go to zero, those guys would be forced in bankruptcy and all the rest. So I don't know. But, in any case, it's 10%, so it's particularly low. US hard landing, 9%. All right. Even though, people have called it for, hard landing for 2 years plus now, and we didn't see a recession. Yeah, there's always the case that the NBER is not going to declare one up until 6-9 months after the fact. But all right. So, this is just, I think at the end of the day, you should take the relevancy of it, inverting it. Like, if there is something like this one right here, where everyone is fearful of, I guess this is not that something which is going to impact the market in a very catastrophic and negative way. Not just because, the majority of people will be wrong, but even if they are right, if they all acknowledge that, they're going to, put on edges in order to, shield themselves and their balance sheet from these eventuality to happen. So at the end of the day, it's going to be priced in. Valuations, I always said, yeah, I mean, they could impact returns over the next decade, but in the very short term, they're not a good timing tool in my view. So, I just wanted to look at them to see what could be the overarching theme getting into next year. If I had to pick one, what would I pick? I think, the thing that I'm following the most at the current moment in time, it's not here, to be quite honest. Yeah. And, at least now, on December the 27th, it's not on this chart. Because for me, I would bet on something going wrong in the credit market. So maybe could be this one, crisis in private capital. Maybe, but I I would be more worried about something actually, the usual cockroaches that Jamie Dimon referred to back in the days. So, private credit, private lending, repo market, dealers, money circulation, collateral impediments, and all the rest. Or, lack of pristine collateral. The underpinnings of the financial system, which are at the end of the day what actually defines the level of liquidity present into the system. Because again, I do think liquidity, especially the lack of liquidity, at the same time you have that huge levels of margin debt present in the market, that's what could really and quickly send these markets to oblivion, in relative terms, obviously, if it decides to show his ugly head. So, yeah. Other than that, I think there's really nothing else to discuss. At this point, the next time we are going to talk, it's going to be a brand new year. So, have a happy New Year Eve. And I hope you're going to celebrate well. Same as I hope your Christmas went all well and good. And we will talk again in 2026. Sounds so powerful when you say that, right? It looks like we are going to be away for such a long, long time. It is just a fucking week at the end of the day, right? So, in the meantime, so let's put it this way. From here to 2026, so from here till next year, just remember as usual, be nice and be cool. Peace out.
Mm-hmm. Mm-hmm. Mm-hmm.